Hey everyone, welcome to the Real Estate Reveille, your dose of real estate inspiration. I'm your host, Daniel Colletti, and I'm passionate about helping you unlock the secrets to financial freedom through real estate investing and entrepreneurship. Whether you're a seasoned investor or just starting on your journey, you'll find practical advice, market insights, and actionable tips to help you build a thriving real estate portfolio. Let's dive into the world of real estate and take your financial future to the next level. Hey everybody, welcome to the Real Estate Reveille. I am here with Fernando Martinez, a graduate of the United States Military Academy at West Point. He's got over 15 years serving on active duty as a Black Hawk helicopter pilot. He's recently transitioned to the reserves and is now a loan originator with Evolution Mortgage LLC. He's the owner and co-founder of the Gray Line Group LLC, and also works as a military consultant. Nando and I first met at BPCon 23 last October, and which is crazy that it was that long ago already. Ended up joining the same mastermind group. He was already a part of it, and it's been awesome to get to know him already. So, Nando, welcome aboard.
Hey, thanks, Dan. It's great to be here, and great to talk some mortgage and some real estate stuff. We both love it, so it's good to be here.
Yeah, absolutely, man. So I'm pumped about this because Nando and I are going to be doing this once a month. Once a
Mhm.
month, we're going to be doing this mortgage monthly segment and talking about all things lending and leveraging and mortgage related to help listeners kind of to understand these products a little bit better and get familiar with it. But before we jump into that, Nana, why don't you tell me a little bit more about one, anything you just want the audience to know about yourself, and what you've done in real estate and investing, and how you got to the point where we are today.
Yeah, appreciate it. So, I mean, you hit some of the big highlights. Um, for West Point grad, class of 2008, then went into aviation in the Army, bounced around like most people do, different duty stations, and then ended up over with the 160th SOAR doing the kind of special ops stuff at Fort Campbell, and ended up getting out there. So I'm based out of Nashville. I ended up sticking around to like the area. Um, and sort of I got out a little earlier than originally anticipated. I didn't stay till 20, but I am doing the reserve thing, so that's one of my buckets. But when I was transitioning out, I was kind of deciding how I wanted to structure my life, and decided to go more the entrepreneurial path, because real estate was already a big thing that I was doing with my business partner and longtime friend Travis Featherstone, who the two of us created the Gray Line Group together for real estate investment purposes. And as far as real estate goes, we both kind of I would say stumbled into it a little bit. So the typical military person, you PCS, you buy a house, you PCS, you buy a house, and before you know it, you got a couple, and you're like, I think I'm a real estate investor. So that was kind of how both Travis and I sort of stumbled into it, and we decided this is something we wanted to continue doing, and so we partnered up, and then kind of went from there. So for me, I've got a few rentals, both long term and short slash medium term here in the Nashville area. Travis has his own personal portfolio, and then combined in the Gray Line Group, we focus more on commercial um, products, commercial multifamily, and then also some other kind of creative commercial development type stuff. And then on the mortgage side, I started doing that as a more, real estate. A lot of people say is passive. It's not the most passive in most cases, and not in mine either. But I still needed it, to fill a few other buckets besides just real estate investment, at least the way I wanted to structure things. But I wanted to stay real estate related. I was thinking about doing the real estate agent thing, but mortgage and the finance side seemed like a better fit for me. In real estate, I think just like in the military, you do a lot of problem solving, and I felt like the finance side of the real estate deals was the sort of problems that I kind of gravitated to and I was interested in. And so helping, borrowers with their mortgage needs is obviously a good way for me to stay strong and smart on the finance side. And real estate, it helps, I get to help them out. I'm obviously making an income from it, but it also, I think, makes me a little bit smarter of an investor than I would be if I wasn't doing that. And so those two are like my two main buckets. I do a little bit of DoD consulting on the side, and then obviously got the reserve thing going on. So transitioned out of the Army last February, so I'm almost at my first full year as a civilian. And so just been really digging into it, figuring out how to like adult, if you will, outside of the Army. The real estate stuff I was already doing and getting into the mortgage stuff. So it was just good to do all these things kind of more full time now. Um, and yeah, as a mortgage LO, I'm currently licensed in 6 states, soon to be 14 in the coming month or two. So I'm currently licensed in Tennessee, Virginia, North Carolina, Georgia, Alabama, and Florida, and in the process of tacking on Kentucky, Missouri, Kansas, Texas, Colorado, DC, Maryland, and Washington. So I will be in 14 states very rapidly. And then working for Evolution Mortgage, we do a lot of VA stuff with conventional kind of VA buyers and or normal conventional mortgages VA, but we do some investment stuff too for people. And our team does specialize in the VA side of things, and we have a lot of veterans, a good chunk of West Point grads, and veterans from other services too in the company. The company is currently licensed in 20 states and expanding to 30 this year. So kind of a small but mighty LO team, and rapidly growing. So that's pretty exciting. And then on the investment side, like I said, with my partner Travis, we're focused on the commercial side of things. So working those problems every day are always interesting. So
No, that's awesome, man. It's cool to hear too the different buckets you have going on. I know, especially that's a big jump that you made last year, transitioning out, and a lot of people might scratch their heads at you on transitioning at that point. But all of the things that you got lined up are also really exciting, and I know I'm pumped to see where you go in all your different initiatives and where the Gray Line Group goes. I know you guys got a lot of stuff in the work, so it's exciting. Um, to talk about Evolution Mortgage really quick, is there anything before we jump into the product itself? Is there anything about Evolution Mortgage that you think sets itself apart from other companies that you might go to?
yeah, absolutely. So I did mention, like I said, small but mighty, but that is like one of our great strengths, I think. Now, granted, we are a growing team, but the really cool thing. So uh, Jordan Com and Mark Kong, two West Point grads, are the guys that started it. They're the owners, founders of the company. Um, Started the team very small. We've grown in the last year, and we're continuing to grow in this next year as well, getting licensed in multiple states. But we are mostly remote. Now we're licensed in a bunch of different states, but we're not all in the same place. We have LOs and processors all over. Like the processor I work with every day actually lives in Montana, but we can do things remotely. We have very little overhead, and so there's not a lot of fluff and extra fees and things associated with our pricing. And so, especially in the VA world, we're highly competitive. That's an area we like to focus on. And I think if you were to ask Jordan and Mark, they'd say that that's an area that we intend to be kind of a big name in and a go-to name in the world of in mortgage lending. So I think it's really cool. It's veteran owned. It's a lot of majority veteran employees, and we specialize in that VA stuff. So it's pretty cool.
Awesome. Love to hear that it's VA owned as well. I didn't realize that, so that's cool. Mm. All right, man. Well, let's jump in. We're gonna do this once a month. We got 12 more topics we're gonna jump into for throughout the rest of this year. So let's start with the basics. This will be great for first time investors or first time home buyers. So why don't you tell us a little bit about just what a mortgage is,
Sure.
and maybe some misconceptions or false assumptions that some folks make out there.
Yeah, sure. So I think one of the biggest things to always start with the basic thing is what is a mortgage. But and I think people think that mortgages are kind of this cookie cutter thing. You're going to get the same thing no matter where you go. But really, a mortgage is a product, and there are lots of different types of mortgages And so the best way I think I can equate this is like if you were to go to a financial advisor for, let's say, and just say, hey, I've got this money, whatever quantity it is, and I want to invest it in something. That advisor is going to kind of take that information. They're going to probably have you fill out a bunch of stuff, ask questions, figure out things like what your income is, where does that income come from, what do you currently have in reserves, what do you have available to invest with, and on what routine, what your risk tolerance is. But ultimately, what is your goal? What are you saving for? Are you trying to save for retirement? Are you making a short term trying to make money quickly? Do you have a high or low risk tolerance? Because depending on how they invest your money, that could mean a lot of things. I mean, you can have in the stock market, you can have lots of swings. You can have something that's slow and steady building. So they then take all that and then they're going to package together a product for you, an investment product or an investment vehicle. And that may be a mix of different things, whether that be stocks, bonds, mutual funds, or you name it. And they may even add in other products to supplement that, depending on what your overall goal is, like life insurance and stuff like that. So that's not exactly the same, but it's similar when you speak with an LO or loan officer originator. You're trying to the initial conversations that you're having a lot of times are a lot of questions that that LO is looking for from you. But they're trying to figure out some of the big things they're trying to figure out are, what are exactly are your goals? What is the purpose that you're purchasing this property? Whether that be a primary residence, whether that be an investment property, a second home or a vacation home, um, and then even going beyond that, is this a residence, for a military buyer, for example, how long are you going to live in this house? Are you going to stay there for 1 year, 2 years, three? Is it a 5-year assignment? Is this your forever home? Because depending on how you answer those questions and what your goals are, that may lead them down one path or another. And at the end of the day, they'll recommend a product that works for you. So that may be a loan type, whether that be like a conventional VA or FHA or whatever it may be. um, that and those different products have different rules and requirements, not only from the governing bodies that control them, but then from the lenders themselves. Because at the end of the day, someone somewhere or some fund or some entity is what's funding every loan. And so they're going to have a risk tolerance and they're going to have different overlays and rules. And so that LO is trying to put together a loan product for you, an investment vehicle, if you will, to help you meet your goals. And that's kind of, looking at mortgage from that perspective, I think makes it easier to understand, because a lot of times people think like, oh, I'm just going to get a mortgage. A mortgage is a mortgage, and they're all the same thing, which isn't necessarily the case.
Gotcha. Awesome. So what, as you've gotten reps on this, are there some things that or misunderstandings that pop up frequently that you kind of have to talk to folks through?
Oh yeah, sure. I mean, one of the big ones is just like how to qualify, which we'll get into here in a few minutes. And then we'll probably dig into a little bit deeper on another episode when we start going really, really down in the weeds. But what I was thinking for today is we could just talk a little bit about some of those common questions, assumptions, misconceptions, a little bit about what it takes to qualify for a loan, and then what the loan process looks like, how you walk through from, hey, I want to buy a property or a home or whatever that looks like. How do I start? Who do I talk to? And then once I start the process, how do I get through it to the day I'm signing at the table, closing docs? So, you know, one of the big misconceptions a lot of times people have is, you know, down payment. That's one. Like a lot of people think, hey, I need to put 20% down to get a mortgage. And that may be true in some cases, but it's not always true. There are loan products. It depends on a few different things. The product itself, is that those products may have rules. So, for example, a VA loan, not always, but in most instances, requires no money down from the borrower. um, Other loan products, may require 3% down, 5% down, just depending on the situation, and also depending on the intended use of the property. Typically, you can get, you'll receive, in most cases, a lower down payment requirement for a primary residence than you would for an investment property. And what that has to do with is how the lender views the risk associated with that property and also associated with the borrower, because the lender is going to underwrite not only the property itself, but they're going to underwrite the borrower, and they're going to determine based on their metrics how risky it is to loan that borrower and money for that property. Um, so the down payment requirement is not a cookie cutter answer. It is very much it depends. Um, Another one's credit. So people think that you have to have like an incredibly high credit score or perfect credit. You can't have anything negative on your credit score. And that's not necessarily true. Now, the credit score is one of the indicators that lenders look at. To that's kind of how they determine whether that's one of the risk metrics for for a borrower. So a high credit score is never a bad thing. But depending on the product, some products don't require as high of a credit score as others. I think a base like rule of thumb number is about 620 is about where most
Hmm.
products that's about the minimum or a good planning factor for most in most situations. But there are some products out there and some lenders out there, depending on the situation, that may allow lower credit scores. There
Yeah.
are some products out there that may require a higher credit score. So, you know, uh, like what they call jumbo loans, in a lot of instances, they're going to require a higher credit score. The higher scores
Yeah.
usually are associated with better terms as well. So, I always recommend, that you want to have the best possible credit score you can. But, do you need to have a 780 credit score to qualify for a loan? The answer is no, not necessarily. But it is something I recommend having. uh,
Yeah, and there's, you said it, the word risk. That's what it's all about for the banks. And when you're talking about the different types of loan products and how one could fit for a certain person compared to another person's situations, a lot of that depends on or is driven by policies, right? Are you trying to get people into their first home? That's where you get that first time home buyer loan where you can, what is it, it's 2.5% down or 3% these days.
it's one of those things. It's going to depend. A lot of times, 3% will work. There are certain situations where there's an advantage to putting a little bit more money down. But those are it all kind of depends. Yeah.
Yeah. The VA loan is 100% down. Best kept or best benefit I think we get in the service, having access to that. And where that 20% down comes from is just that conventional mortgage, right? And all that is based on all of these products are just based on what the government is willing to back if something's to happen. And that's why these banks will step in and provide these products at a certain risk point because the government's willing to cover that delta between, um, you know, 80% and 100% of that price that they're lending to you. Um, awesome. So a lot of factors that were in there already we're thinking about. Before we jump into um, kind of some of those qualifiers, you talked about the credit score a little bit. Is there any other like misconception or assumptions that come to mind that you think folks should be aware of?
Yeah. So another one. This is another one. A lot of these things are very much it depends. But a lot of times people will say, renting. I've seen it both ways actually. Renting is cheaper or a better option than buying. Or I've seen it where some people say like, no, you should always buy a house. The best time to buy is yesterday. It depends. It depends on the borrower. It depends on your situation, your goals, and where you're at. So, um, a perfect example. So renting sometimes is cheaper than it depends on your market too. And it depends on the terms of your loan, interest rates, all these things factor in. But in certain instances, renting is the smarter choice. So I'll give you a quick example using myself. So being an army guy previously, I PCSed, and I was very much of the mindset like, all right, I'm done renting. I'm going to buy houses wherever I'm at. I'm going to build equity. It's an investment. I'll rent it out to other people, have them pay my mortgage. But for me, it depended. So I was PCSing and I was going to live, or I was going to Leavenworth to do CGSC or ILE, and I was only going to be there for a year. Um, at that stage, I wasn't really ready for like a long term, I'm sorry, a long distance rental. I was kind of new to the situation as far as real estate investment goes. And I was only going to be there for a year. Um, I decided to rent for that year, and that was the right call for me. It saved me money, saved me a lot of sort of heartache in that year, just because my goals for that year, I was coming off of very busy deployment cycles and everything like that. My goals for that year were to do CGSC. I was working on a civilian master's degree in night school, and just kind of trying to have a little bit of a decompression year. Adding the additional, you know, requirements effort of maintaining and managing that home, plus the financial side of it. I also at the time didn't have a lot of money to put down. My VA loan was already tied up in something else. So I would have had to, so in that situation, renting made more sense for me for that short period. And then when I got back, PCS back, I came back to Nashville area. I was at Campbell again. Um, then I went ahead and bought in my next, at my next spot. So, not every buying is not always the best call. Sometimes, if you're looking for something short term or you're looking for something to sort of a gap fill, renting may make more sense. But then when I came to Nashville, looking at the rental rates at the time, it was 2019, and interest rates were not bad. They got even better a few years later, or in the next year or two. Buying totally made sense. I was going to be here for a long time, and I was starting to build a real estate portfolio. And so that's kind of a situation where buying, and buying can be cheaper in a lot of instances, especially for someone who's got access to a low or no money down product like a VA, FHA, or other, even a conventional mortgage on a primary residence. If you take advantage of a house hack or you buy a property that you have the ability to split or something like that, and you can rent a portion of it, uh, is likely a much cheaper option than renting, and you're building equity and investing at the same time. So that's one of those things. That's kind of two misconceptions, right? Buying is always better, or renting is always cheaper. It all depends.
It
It depends on
depends.
the person. Yep, depends on the situation, the goal, what your goals are, long-term goals, the rest of your portfolio investment wise. Because I think that a very strong investment portfolio always includes real estate, but I don't throw all my eggs in that one basket. I don't only do real estate investing. I have some other stuff too, but real estate is my favorite type of investing. It's the one that I like the most, and the one that I think brings me the most value. You know, but there's time and place for some other things, like I have a retirement account and things like that. And so, yeah, is real estate always the best investment all the time? Well, no, not necessarily. Sometimes it might make sense to park your money in some other type of account for a period of time until you're ready to jump into a real estate investment. Or if you're building cash reserves, you don't want to be over leveraged. I mean, there's a lot of things that go into that. So,
Yeah.
I think a lot of people look at things like mortgages and real estate as very much like there are hard and fast rules that you always have to follow. And I think they're good rules of thumb, and they're most likely the smart play in a lot of situations. Uh, but looking at, everything from the market, your personal situation, your income, your reserves, all that type of stuff, um, you know, that all factors in.
Yeah, you definitely got to look at the local market, and at the end of the day, when you're ready to rent that out, is it going to be paying for your expenses? And that's kind of a double-edged sword that I learned about. And going back to one of my own examples, when I bought my condo here in Manhattan, um, great place to live. It was awesome while I was going to Columbia, outside of the fact that I felt like Will Smith and I Am Legend and the city was empty. But I got a great deal on it and I used a VA loan. So there was no money down. The problem was there was no money down and it was in Manhattan and that market came back pretty quickly. And the trouble I'm facing now, and I got a great couple in there, as my tenants. But it's hard to cash flow on it, especially when prices go up. That means property taxes, assessments are going up, insurance. There's all these variable things that can get raised. My common charges board just decided to double it, um, and you can't just jack up the rent on people. You either got to be cognizant of what your market rent is, because you could just drive away your tenants. um, and then there's also, you don't want to be abusive to your tenants. You got to be responsible as a landlord. And so understanding when you use some of these products like an FHA loan or a VA loan where there's less of a down payment, if you're going to be leaving in 12 months, well, you got to look at how much rent are you actually going to be able to get, and is that going to give you a cash flowing asset, or are you going to end up with a liability? Uh, and so 100% on board with you when you're talking about it depends on your situation. Now, if you're going to be there for 5 or 6 years and you've got that time for that rent to, catch up and increase, then that's where these become great. Or if you're in a cheaper market, then there's a lot of opportunity out there. It seems like the minute I decided to jump in real estate, the army was like, "Yeah, you're going to DC, you're going to Germany, you're going to New York." I went to all these expensive places, and I was like, "All right, look, renting is smarter for me." Uh, and that's I got to Manhattan and was just like, "The hell with it! I'm going all in. I'm buying anyway." No, that's a great point. Keeping in mind when it's important to rent versus buying, and but also not being afraid to buy when you should, when the market
Mhm.
conditions are right, and uh, that getting a mortgage is not that difficult. There's a lot of great products. Nando's out here to help you. So why don't we jump into briefly? What are the things that people should be thinking about? They've made the decision they want to go buy. Uh, how do they qualify? And I know we're going to deep dive in this in a later episode, but what are the key things to keep in mind?
Yeah, absolutely. So, um, the I try to break this kind of when you talk about qualifying for a mortgage. I mean, there's probably a little bit more to it than this, but there's kind of four main things that I like to think of. Um, and all of it, remember, as we talked about before, is how a lender or is going to assess risk against not only or against the borrower. So this for qualifying, right? They're mostly focused on the borrower. Now, when it comes to underwriting and some other things we'll talk about a little bit later, there is some stuff that they have to underwrite versus against the property. And this is another one of the things that is a lot of times a little bit of a difference between your residential and commercial, or some of your creative finance type things, hard money loans. There's a lot of kind of stuff out there that they may have a little bit different, rules or less rules. It's a little bit more, it's called creative finance for a reason. You can get creative. It's a little bit the wild, wild west in some
Yeah,
instances, and the
from the
commercial side is
conventional.
is very much.
Oh
But
yeah,
yes,
yeah,
for like
very
for
different.
a conventional, yeah, for a conventional mortgage, or well, I should say, yeah, most conventional products. When I say conventional, I mean VA, FHA, even DSCR. That one's a little bit more unique than the others. There's things USDA loans or some other stuff like that. Physicians loans. There's different products. One of the first things they're going to do is they're going to underwrite the person, the borrower. And so the four main areas they're going to look at: one, your credit score, which we talked about. And what that credit score really is an indicator of how reliable you are as a borrower, um, how reliable with regard to paying off your debts and your bills, right? So we talked about that 620 is sort of a good magic number, but not necessarily a hard and fast rule. Different products require different things. So it's important for any prospective buyer to have a good idea what their credit score is and what things factor into that credit score. Things like payment history, things like usage, like credit usage. So, if you have, your credit limit on a credit card, or your credit cards is X amount, how much of that are you using regularly? And then are you paying that back off, and are you paying it back off in full, in portions? Are you paying everything on time? Do you have late payments? All those types of things will factor into your credit score. Next big one is going to be cash reserves. How much money do you have saved? Not only in a savings account, but other accounts count in this as well. So things like brokerage accounts, IRAs, um, trusts, things you have access to, liquid cash or investments in some cases, like like mutual funds, things like that. But what is the value of that? And the lender is looking for that because they need to know that you have an access to enough money to, one, make a down payment, whatever that is, whether it's a small down payment, like a 3% or a 5% or a 20 or a 25% down payment, depending on the situation. You have to have enough money to pay for that, plus whatever the cost of the loan product is, the closing costs. You have to have enough money to be able to do that. So that's one of the things that they're going to be looking for. And in some cases, people with large cash reserves, they can also, that's a little bit more unique, but they can also use that to sort of underwrite the risk of borrowing to the borrower as well. So if you're going to buy a $300,000 house, but you have, $600,000 in various accounts, that could, in some instances, um, be of use when they look to underwrite you for that risk. Um, Next couple areas are your incomes and your debts. Those are the next two areas. So, how much money do you make? They're looking on a monthly basis. Um, and the type of income doesn't matter. There's lots of things that can factor into income, which once again we'll talk about. Um, you know, whether your income type is W-2, self-employed, 1099. You can have certain types of other unique income, disability, alimony, child support, rental income. These things all matter and can be factored in. So
And they're
how
really
much money are you
looking,
bringing in? Oh, yeah, sorry, go ahead.
yeah, because they're really looking at the reliability of that income, right? What is the likelihood
Correct.
that the bank, can count on that money coming in? I know for the VA loan, one of the things that we have going for us, especially when we're on active duty, like they know that check's coming, right?
Hmm.
Outside of Congress not passing a bill and not getting a continuing resolution, like we're getting paid, so that's pretty reliable W-2 income. Down to maybe child support, less so, depending on the situation. But these things are the risk are in different categories, right?
Yep, and they're looking for, hey, how much money are you bringing in per month? And then the debt side of that, how much money is going out? So they're primarily going to be the things that matter most when it comes to debts are things that will show on a credit report or a credit inquiry, I should say. Things like car loans of any kind, mortgages, car loans, student loans, credit cards. Credit cards is a big one. If you have a really high credit card debt, that could be a negative factor. um, but they're not necessarily looking at your budgeting to see how much you spend each month. So like they're not going to care about your Netflix account or how much money you spend at the bar per se. But if you're putting all that on your credit card and you're not paying off your credit card, well then that that could be a factor. So the things to focus on are what can be seen on a credit report. And so your credit score is important, and that your debts on a credit report. And something that people don't always know is you have access to your credit report once per year for free. So you can actually go request that and get that information. It doesn't include the score. I think you have to pay to receive that, but it does at least tell you, hey, well, here's all the things that are showing on your credit report. So if somebody goes to do an inquiry on you, and it's important to know these things because there are times where people have stuff on their credit report that they didn't realize. um, Whether they got, if you got taken to collections for something and it never made it to you or whatever it may be, that could be a problem. So being
Yeah.
familiar with your credit and your credit reports very important. Understanding, how much money you have coming in monthly and how much cash you have in reserve. Those are kind of the big factors there.
Yeah, and I don't want to go down the credit rabbit hole because that hole is very deep. But
Yeah, that's an
there's
episode in and of itself, right?
there's a whole different kinds of credit scores, and you can go to Credit Karmas and the MyFICOs, and a lot of credit card companies can show you certain scores these days. So there's even some variance which can cause some confusion for people. But there's also some really simple ways, for the folks out there that are concerned about their credit score. You can very easily write letters and do certain things to have late payments removed. And just doing maintenance on your accounts so that when you go to apply for mortgages, that there are less concerns. One thing, just a quick example I found in scrubbing my credit profile as a military member, every time we move, every time we change addresses, that becomes an address on our credit portfolio. And when these start to stack up, they can create concerns for fraud. And so that's the difference between going through an underwriting automated system versus being directed to a person. And when that happens, it's much more likely that there's going to be scrutiny on your account. So even just making sure you've got the correct name, one address, one email, one phone number, some of these little things can actually improve the likelihood of you getting approved without some scrutiny. Um, but great rundown on that credit score, cash reserves. On the cash reserves, that I know that can change sometimes. You can look at Fannie Mae
Fanny.
and Freddie Mac, thanks,
Yeah.
on what their requirements are, and it can ebb and flow between 6 months and 12 months, depending on what's going on in the economy or the other factors, the risk factors that you're presenting. But I know a good general rule is you want to have at least 6 months to really ensure that you're not going to run into any issues um, to get that loan. And then one thing, I'll just leave with folks, for the VA loan that I used in New York, for example, I was able to use my TSP as my cash reserves in my Roth IRA, which was
Mhm.
awesome because I had enough in there that it brought my risk portfolio down, and I was able to actually bring up my offering price to the seller with a concession. And so I didn't have a whole lot of liquid cash without tapping into retirement accounts, and so I was able to offer them a little bit more with a $25,000 concession, and then use that for the closing costs. And so that allowed me to make the acquisition without touching some of my investments, which was a great technique to use for me, and that a lot of people can use. Thanks for joining us on the Real Estate Reveille. Tune in next time for the next part of this episode where we break down the steps to getting a mortgage.